Did you know the average investor loses 1 to 2% of their returns to taxes every year? That's often more than what they pay their financial advisor. Most investment firms focus exclusively on market returns, but at Range, we know that what really matters is what you keep after taxes. In this video, I'll show you how our strategic tax planning creates what we call tax alpha, additional returns that do not come from the market, but from intelligent tax management. These strategies can add 1 to 1.5% to your annual returns without taking any additional risk. The first pillar of tax alpha is asset location, placing investments in the right types of accounts. For example, investments that generate ordinary income like bonds are traditionally better in tax advantage accounts like IRAs, while growth-oriented investments often belong in taxable accounts where they can benefit from lower capital gains rates. Research shows this strategy alone can add 0.05 to 0.30% to your annual after-tax returns. On $1 million portfolio, that's an extra $500 to $3,000 every year. But the real power comes from automated tax loss harvesting. When markets fluctuate, which they always do, individual stocks or ETFs will inevitably decline in value temporarily. These temporary declines represent tax-saving opportunities. At Range, we scan portfolios daily for tax loss harvesting opportunities. When we identify a security that's down, we can sell it to capture the tax loss, then immediately purchase a similar, but not identical security to maintain your market exposure. These harvested losses offset capital gains or up to $3,000 of ordinary income each year. Any unused losses carry forward indefinitely, creating a tax loss bank you can draw from for years to come. Most advisors might harvest losses once a year, or maybe during major market corrections. Our daily approach captures significantly more opportunities. Research shows daily tax loss harvesting can add over 1% annually to after-tax returns compared to less frequent approaches. This is especially powerful with direct indexing, a strategy that replicates an index by owning individual stocks rather than ETFs. When you own individual stocks, you can capture losses on specific securities, even when the overall market is up. In 2024, the S&P 500 returned over 25%, but nearly 70% of individual stocks experienced drawdowns of more than 15% at some point during the year. Each of these individual stock declines represented a tax loss harvesting opportunity that most traditional investors missed. Think about what an extra 1 to 1.5% in annual returns means over time. On a $1 million portfolio over 20 years, that's an additional $350K to $525K in wealth. This isn't theoretical. It's real money that otherwise would go to the IRS instead of supporting your retirement, your family, or your legacy. At Range, we've built our investment approach around capturing these opportunities systematically and automatically. While other firms focus exclusively on pre-tax returns, we're equally focused on what you actually keep. Discover how much tax alpha you could be capturing with Range. Book a demo today to see our tax-efficient investment approach in action.